All right, Sleep Number is a crazy stock. This is going to be one that is super interesting, super informative. It was actually featured in my first group valuation video, and that was published on, I think, January 22nd. So it was right after this dip here. Let me show you. If you look at the stock price, January 22nd was right. Yeah, it was like published here over the weekend, and then it immediately spiked up like over 10%. Let's see, how much was this? Yeah, 10%. And I wanted to do a video on it, but I hated doing videos on stocks like right after a big run up. I just think, it's much better to catch them on the way down, right? And then wait for them to come back up. So I was a little disappointed, but I thought, okay, I'll just wait. If it drops more, I'll probably do a video on it. And look at this. It dropped a lot. I mean, since this, it's been down 18%. That's pretty crazy, all right? So we're going to look at the financials and see, is this a huge buying opportunity? All right, we're going to start with the income statement first. All right, so look at this revenue growth. This is every quarter going back to March 2005, every quarterly report. Sleep Number is the mattress company, right? The one where you dial in your number and you get the, I don't have a Sleep Number bed, but they're super expensive mattresses. And look at this revenue growth. I mean, they're really ramping up. Can you believe this? They're making $600 million in mattress sales per quarter right now. It's insane. And the growth, it's like exponential. All right. One thing I'm going to start doing here is on the outline section, I'm going to highlight different metrics over here, green and red, just to kind of have a visual aid. So you'll start seeing that. All right, let's move to gross margin. All right, so gross margin is one I'm really going to be paying attention to for a lot of companies, especially product companies, and especially product companies that sell non-essentials. Inflation is going to hit those the hardest, so watching a company that can maintain good gross margins is going to be really impressive, because think about it. They're paying more for all their stuff that goes into their mattresses, but if they're able to keep a steady gross margin, that's awesome. And look at this. The gross margin is 60%. I mean, it's a luxury brand. Luxury brands are going to sell for a high gross margin, but still, over 60%, that's awesome. All right, I'm giving them a green on that too, so let me put that in real quick. And then I want to show you research and development, so let me pull that up. This is, first we're just going to look at plain research and development and I like to do this for any product companies, but look at this. It looks like it's going up on an exponential, but think about it as a percentage, right? So $14 million a quarter. If you remember, their income, or their revenue was like $600 million a quarter. So look at this percentage, 14 divided by 600. Like 2% of their revenue they're spending on research and development. I guess there's not much R&D for mattresses, but that's awesome. I mean, I say that's awesome. It's just one less thing to worry about in investing, right? If you're investing in a company that has high R&D as a percentage of revenue, that means that they're always having to stay on the cutting edge, try to, fend off competitors and stuff. Somebody with low research and development is like, look, we're comfortable with our product. We're not worried about, somebody creating some new super upgraded mattress that, no, they're not worried about that. It looks like they're spending more, but it's just such a low percentage, right? I mean, still think about this. We have $14 million going into mattress research and development. That's kind of funny. All right. That's awesome too. So that's getting a green too. So far we are 3 for 3 on green. And I think it's about to be 4 for 4. So let's see. Now we're going to look at interest per operating income. So I love to look at this because it's like a great way to measure the debt load of a company besides looking just at plain debt, because you're looking at it compared to how much money you're making. Because if a huge percentage of your operating income is going to interest, I've said this before, but that's just like another tax, and one tax is bad enough. All right, so this is going to be an issue if you ever use like some kind of visual pattern like this with an auto scaling graph. It's just the scaling is going to be messed up sometimes, because especially whenever you're looking at percentages, because if you have a small denominator for one quarter, it's going to drive that percentage way up and mess up all your scaling. So look, I'm just going to come down here and look at the most recent ones. The most recent ones were 2%, 5%, 1%, 1%, 3%. Pretty crazy, okay? That is awesome. 1%, 2% of your income is going to interest, and then you have like a tiny percentage, 2% of your revenue going to research and development. That means that you're probably going to be taking home a lot of that margin as pre-tax income, which is like the best way to take it, right? All right. Let's go to pre-tax. All right, here's your pre-tax income. I'm not going to be marking this one red or green because I'm going to be putting a number there. It's a little bit lower than I would have thought. Remember I said we had $600 million a quarter in revenue, and then 60% gross margin, low R&D, low interest, but you're only coming out with about 10% on a pre-tax basis, maybe a little bit higher than 10%. I mean, that just means you have other expenses. It's not that big of a deal. Of course, we like to see growth, so that's awesome. I mean, just in the last couple of years. They've gone from less than $40 million a quarter to, well over $60-70 million a quarter, approaching $80 million a quarter. All right, so how am I going to get a number for them? Remember, this is going to go into our like quote unquote just back of the hand calculation, multiply by 10 valuation. So I like to figure out what I think it's going to be based on this chart. And if you look at it, I mean, we're coming up, but at the same time, I'm expecting lower income, lower sales because of, inflation. So I'm going to say that it's going to dip down a little bit and be about $60 million a quarter. That's pretty arbitrary. That's just me reading the graph and kind of making an educated guess. If I was really, really going to be invested in this company, I'd be much more focused on that number than I am right now. All right, but this is just kind of like a screening process, right? Okay, so $60 million a quarter times 4, that's $250 million on a yearly basis. So I'm writing that down over here, $240 million. And now we're going to go to growth. Oh, I got to get a growth from here. How do I get growth? I always say this, evaluate from peak to peak. Don't go pit to peak or else you're going to get an inflated number, okay? So back here, 2015, they were at $40 million a quarter, and I just said that they're at 60 in 2021. This is numbers from 2021. Really, they were a little bit higher than that, maybe let's say 65 to be nice. So 65 divided by 40, I need to get that annualized. So I raised that to the 1/6 because we went from 2015 to 2021, so that's 6 years. So raised to 1/6, and that's an annualized growth rate of 8%. You can see that right there. All right. Awesome. Pretty good growth, especially for a mattress company. It's crazy, okay? I don't think I ran through their fundamentals or whatever at the beginning, just their intro section. So just to reiterate, they are a $1.4 billion market cap. So I think that's actually a small cap because it's under $2 billion. I think $2 billion is the cutoff for small cap, and they're selling for $63 a share right now. Okay, let's go to earnings per share. See this. I remember one thing from my video on them, that group valuation, was that they're buying back a lot of shares. So I'm expecting this to be higher. Yeah. Oh yeah, this is awesome. So you're going to see on the balance sheet, but they're buying back a ton of shares. So what's that doing? In addition to buying back shares on the balance sheet and increasing your equity, you're also going to be increasing your earnings per share. So their income was going up already, and then they're reducing the number of shares. So you're getting a lot of money per share. This is awesome. Okay, so I'm going to take the trailing 12 months. So if I do that, trailing 12 months would be, let's see, $7.80. So let me write that down over here, $7.80. And now let's go to the balance sheet. First thing I'm going to look at on the balance sheet is total tangible assets, because I want to get a return on tangible assets, but I don't like to look at return on tangible assets by itself because I want to know, are assets growing? Because if your assets are growing and you still have a good return on tangible assets, that's way more impressive than having like a steady asset base and your return on assets, just staying the same there. All right, so it is growing, okay? And, big jump up recently. So from $400 million in total tangible assets to $800 million in total tangible assets. So pre-tax return on tangible assets, this is a percentage, so I got to put it in a percentage. All right, the scaling's messed up here too. I'm just going to remove this one, okay, to help the scaling. All right. Wow. Oh, man. Around 30%. I mean, that's an insane return on tangible assets. That means that you have assets that are producing, paying for themselves in like 2 to 3 years, right? So 30%, that if you buy something for $100,000, you're making $30,000 a year pre-tax on it. That's awesome. And one thing here that you'd want to look out for is that sometimes if you get a really high tangible asset return on tangible assets, it's because you have a lot of intangible assets. So whenever you subtract that out, your denominator shrinks. So you're dividing by a smaller asset base. But really, they don't have that many intangible assets. They're a smaller company. They don't have a lot of goodwill. They don't have a lot of intangible assets. I mean, I'll just show you real fast. I mean, they have their total assets. Let me go back to dollars. Their total assets is like, let's say, what is this, 900 million? And I said there were like 800 million tangible. So really, they're mostly tangible assets. So this pre-tax return on tangible assets is a real number, and it's awesome. Okay, that's a green for sure. All right, let's go to total equity. Let me put this green first. All right, total equity. So let me scroll down here. Where is it? Total equity, gross minority interest. Okay, that's just how Yahoo Finance classifies it. I was editing them to make them look better, but I figured I'm just going to keep the same nomenclature that Yahoo Finance uses in case anybody else uses that software. All right. Oh, I got to put this outlier back in. Not out. Okay. All right. Wait. Yeah, I remember this now. Okay, so Sleep Number has negative equity. It's crazy, okay? This is what blows my mind. This is what confuses me so much about this stock. There's a couple things that confuse me, and we're going to get to those. But this, for one, is just like, what? If you remember in my other group valuation video, the one I just posted a couple days ago, I said a company with negative equity is just an automatic X for me, okay? And they have negative equity. So I'm like, man, what the heck's going on? Okay, so let's see. We're going to look at the assets to liabilities ratio to see how bad this debt is, right? We're going to see, assets to liabilities, everything you own divided by everything you owe. All right, let's go to assets to liabilities. Okay, so this ratio, you want it to be higher. I know debt to equity you want lower because debt's on top and equity's on bottom. In this case, you want it to be higher because assets is on top and your liabilities or debt is on the bottom. So a lot of people will say that over 2 here is good, and I think if you read, I think it's Warren Buffett and the interpretation of financial statements, they say over 2. Maybe it's 1, but I think it's over 2. You obviously, if you're under 1, it means you're going to have negative equity, so you do not want under 1. But, they are under 1 and they're shrinking. It's crazy. I don't understand that either. Look at this. So what's the most recent ratio? It's like 0.6. So that means that their assets are only 60% of their total liabilities. It's kind of crazy. So strange. All right, let's go to number of shares, and this is where the shock's going to come in. Let me make the assets to liability red too, just because that's so low. All right, here we go. Number of shares. I remember this from the group valuation video too. Where is it? Ordinary shares number. Shares outstanding. Here it is. What the heck? They're buying back shares like crazy. So they're really sending mixed signals here in the balance sheet, all right? They got negative equity, but they're buying back shares. You buy back shares so that you can increase your stakeholders' equity per share, right? Or you can increase their earnings per share and equity per share. And Warren Buffett, in his book, it's not his book, in his letters to the shareholder, one of his essays, he writes that he was authorized to buy back shares whenever they were at or lower than 120% of their tangible book value. That was his criteria to buy back shares. Or maybe it was just book value, 120% of book value. I forget if it was tangible book value or just book value, but still, it was based on the equity per share. It was based on the book value of the shares. That was their only criteria for buying back shares. Because what I always say, it's like the net worth of the company. Well, here we see the net worth shrinking. Because I don't know, they have a lot more debt than assets, but they're buying back a ton of shares because obviously everything else is good. So it's just a really big head scratcher. It confuses the hell out of me, and you're going to see, the consequence, because this is just something you never see. Watch what happens. You're buying back shares, but your equity's shrinking and negative. So this is going to make your equity per share be going down on like a reverse exponential. Look at this. It's crazy. It's like a vertical down. Wow. You get negative $20 per share by buying this stock at equity per share. Strange. But everything else is good. This is why in my group valuation video, they got a yellow here. All right. Now we're going to look at the cash flow statement. We didn't look at the cash flow statement with the group videos, so this can be our first time looking at it. All right, let's go there. All right, free cash flow first. So this is a little interesting. I guess it's about the same as the pre-tax income. It's just really fluctuating. That they have very cyclical quarters for cash flow. There's nothing wrong with that. It's just the nature of the beast with cash flow that you're going to be more cyclical than income. So let me fit a trend line here. I like to use trend lines for the cash flow statement whenever it's jumping around like this. So let's just do a linear trend line. Looks like we're about at, let's say $50 million a quarter in income, not income, $50 million in free cash flow. 50 times 4 is 200, so I'm going to put $200 million down here in free cash flow. All right, it's growing. If you look at the top line, it's actually growing faster than the bottom line's steady, but the top line's growing, so that's good. Hopefully, they're maintain free cash flow around here, between 75 and 100. Then, between 50 and 100, around 75, it's going to be much different story. But 200 million per year is pretty nice too. All right, now we're going to look at these buybacks because I want to see when they bought back the stocks and how much money they spent buying back the stocks each time. Okay, so let's see. Here it is. Repurchase of capital stock. Looks like they bought back shares for a while before COVID. Then they had 2 quarters where they didn't buy back shares. It looks like it was quarter 2 2020 and quarter 3 2020. then quarter 4 2020, and then the next 3 quarters, they bought back a lot of shares. Let me show you something interesting though, okay? I'm gonna pull back up the share price. So let me show you this. All right, and I'm actually gonna move it down here so we can look at it where the quarters were. Okay, so let me pull up a 2-year chart. So they started buying back shares for the first time in quarter 4 of 2020, which would have been here. So they started buying back shares in this time frame. So they probably spent $70 to $90 a share, okay? Then they spent a lot of money again buying it back in Q1 of the next year, Q1 of 2021, which was like around here, around the super high prices, okay? Then they spent less buying it back as it was lower, and less again recently. So that's kind of confusing. That's a head scratcher. But you know what? We don't have to speculate on exactly what they paid. I want to show you a neat way to go about, picking an average price. So let me show you that. All right, so to do that, I'm on the Sleep Number Investor Relations tab, on their SEC Filings tab, and I'll share this link below, or at least I'll share the Investor Relations link below. So here's their annual report for 2020, which will tell us, their average price paid for the 4th quarter of 2020. So let me just show you how to do that. Okay, so you pull up the 10K, and you go up here, Control F, average price. All right, if I type in average price and it brings me here, this is total number of shares purchased, this is their stock, and it tells you the average price paid. So they bought 2.7 million shares for $71, okay, $72 a share. I'm going to do all this in the calculator. It's going to take a little while, but if you want to just fast forward till the end, I think it'll be like 1 minute. Not to the end, but fast forward 1 minute to see the what I get with. So, okay. But if you want to learn how to do it, just watch. Okay, so this is just going to be an average. Okay, so they bought back 2.7 million shares at $72. I'm going to do a lot of rounding here, okay? Then the next quarter, let's see. I got to go to quarterly filings. The next quarter was May 2021. So if I pull that up, Control F, average price paid, okay? See, here's the big one. They bought back 1.3 million at $137 a share. All right, that's a lot. All right, then, okay, let me do it again. They bought back, let's see, the next quarter was this one, and if I Control F, they bought back 0.9 million, so 0.9 times 112. Then they bought back, the final one that we're going to look at is the most recent one. They bought back, let's see, 1 million shares at 97. 1 times 97. All right. Now what I have to do is I have to divide that by the total number of shares that they repurchased. So to do that, I divide by 2.7 plus 1.3 plus 0.9 plus 1. So that was confusing. It's just the number of shares. So divided by 2.7 plus 1.3 plus 0.9 plus 0.1, not 0.1, plus 1. And I get that their average price paid was $97 a share, okay? It's crazy that they don't tell you, all their previous quarters. They only do the most recent quarter. I tried to find, it'd be nice if they had this data for everyone. So this is the only way to really go back and do it. But anyway, over the last 4 quarters, they've spent, let's see, how much money? They've spent they spent $575 million buying back their shares at an average price of $97 a share. So let me put that here, 97. All right, let's go to valuation. Let's see what we get for our price target. Okay, the easy one first, right? I just take what I estimate as the pre-tax income, multiply by 10, and then divide by the number of shares. So 240 times 10 is 2.4 billion. And then if I divide that by the number of shares, 22.6 million, I get an average price target of $106 a share. All right, awesome. All right, next one is the Ben Graham formula, earnings per share plus growth, or earnings per share growth formula. So let's do that. 780 times, let's see, 8.5 plus 2 times growth, which was 8%. Wow. Oh man, I'm going to get a huge number. 191. Wow. Okay. I think my growth rate's a little bit too high, so I'm going to just cut the growth rate in half to see what I get doing that, okay? I'm super nervous about always getting an overvaluation and thinking that, somebody thinking that it's like the best deal of the century and messing up. Okay, so look, even if I cut the growth rate in half, I'm going to get 129. So I'm going to keep that. I think that's more reasonable. I think here, let me put in the growth over here. I'm going to put 4% in parentheses, and I changed it to 4% for this calculation. All right, and now the free cash flow or discounted cash flow method that I use this spreadsheet for that's running in the background, I'm going to put my free cash flow in, not billion, but in million, which was 200. All right, and then I'm going to get a perpetual growth rate. I'm going to say they're going to grow at, let's say, 3%, from now till whenever they go out of business. And then discount rate is going to be 13%. Okay, so I know I used to discount at 15%, but what I've decided is that I want to be a little more precise. I think 13% is better. And then on my end, I'm just going to be assuming a larger margin of safety before I buy stocks, okay? So let's see, net present value, 2.26, it shouldn't say billion, 2.26 million. So that's my market cap estimate. And you see how this graph plateaus. Whenever you're discounting at such a high rate, your numbers, even though we're discounting, even though we're doing a DCF out 100 years, you really stop counting after like 15 to 20 years, right? Okay, anyway, I'm digressing. Let's do this. 2260 divided by the number of shares, 22.6. Oh, exactly $100 a share. That's like magic, huh? Look, this is obvious. It's definitely selling at a discount. What's strange is there's a couple things that are super strange here, okay? The first one is the equity, the shrinking equity. That just blows my mind, okay? The shrinking equity combined with buybacks, I've never seen that. I think that's like the craziest thing I've ever seen. Now, it might be justified because they're making so much money. They have such great return on tangible assets. But then I'm kind of questioning the buybacks even more, because if you're making such a great return on tangible assets and you were doing it with incremental assets, could you have invested more to make more money, to make, continue to make 30% on tangible assets? That's kind of the head scratcher for me. In addition to that, if you go back and look at their buybacks, they bought back more of their shares at the higher price than they bought back at the lower price. So that seems counterintuitive to me too. Wouldn't you want to buy back your shares if you thought it was at a discount? Those are head scratchers. But at the same time, I think that this could actually be like a really hidden gem that is flying under the radar because of the negative equity and just because it's a mattress company, and who wants to own a mattress company, especially in a high inflationary period, especially when I think another mattress company just reported bad earnings today. It's like there's a lot of negative press surrounding them. I think they're also involved in a lawsuit, but it really could be creating like a huge buying opportunity, and I'm going to be watching this stock. I got a price in my head that like below 60, it'd be really hard for me not to buy it. In fact, I'm really considering it now. The only issue I have is that I don't really want to sell anything else that I own. That'd be breaking my equity rule too. So I don't know. It's confusing, but I definitely see a lot of potential. Look, I hope you learned something. If you have anything to add in the comments, please do. Any discussions, much appreciated. Thanks again. See you next time.